Hey, welcome back everybody. My name is Kepley. I'm with howtoplaystock.com, and today I wanted to cover a different video and switch gears here from the Forex market, because I've been shooting some videos on the Forex market. So I'm just shifting gears here a little bit, and I wanted to cover another financial tool or asset that you can use. Now this is a tangible asset. This is a physical asset that you can actually feel and touch. Now these are, in my personal opinion, these are better investments than paper assets like stocks. And the asset I'm referring to here that's tangible is gold. Okay, and I want to cover the topic of gold real quick because right now, it's July 13th, 2016, and right now in the markets you are seeing a lot of volatility going on. Central banks are starting to get in trouble with the massive amount of quantitative easing they have done over the last 8 years. And so you're starting to see the markets kind of crack and fall apart. Okay, now this is not anything new that we have not been through before. Okay, stock markets, guys, will go up and down. They're going to have bull markets and they're going to have bear markets. Okay, the reason why I want to touch on gold though is because this next market crash that we're going to see, I personally believe, is going to be one that's a currency issue and a credit liquidity issue. Okay, so like if you go back and you do a little research on 2008, what happened with the banks, with Lehman Brothers, and you'll find out when you do a little bit of research that the crisis that we had in 2008 was a liquidity issue. All right, they ended up freezing liquidity in the markets, and banks at that time were basically, they didn't trust one another, and they weren't trustworthy. They were scared to do business with each other and exchange cash through transactions. So that's what I mean when liquidity freezes up and you have a credit freeze. That's what happened in 2008 with the banks. Now in times like that, gold is something that you want to hold on to. Okay, and the reason why is because gold has been around for thousands of years, guys. All right, it's always been in some shape or form. It's always been a way for economies to go ahead and barter, for buying and selling of goods. All right, so that brings me into this first piece here. Under a free market system, it has a price. Okay, and it's called a spot price. So all you have to do is just go out online, look up the gold spot price, and that will fluctuate on a daily basis. All right. Now that price though is compared to the price of all other currencies in the global markets. So basically it goes off supply and demand, and that's what you're looking at when you're looking at the gold spot price. And that spot price is based off of 1 ounce of gold. All right. Like I said here, it's going to help hedge against market risk. All right. So in times like 2008, when you had liquidity freeze-ups of cash, luckily they were able to fix that. But if they weren't, and let's say we had months on end where basically there was inflation or the devaluing of a currency, like what we might face here in the coming 6 months. When there's a devaluation of the currency, it means things are going to cost more. So it's going to take more dollars to go out and buy that gallon of milk. It's going to cost more dollars to go get your McDonald's from a drive-thru. Okay, if it costs more dollars and you're not really getting more dollars per se from your investments, if you're not getting more dollars so that you can keep up with inflation, you're going to have a problem. Okay, you're going to have a serious problem, and when you have a value devaluation, especially in the U.S. dollar, look at the price of gold, because gold is being, basically thrown up against the value of the U.S. dollar. And every time the U.S. dollar, and this is just from my own observation, but every time the U.S. dollar goes down, gold ends up going up. And in times of crisis, when you don't have a whole lot of dollars, or let's say the dollar becomes worthless, what do you think people are going to turn to? for means of buying and selling. It's going to be gold, silver, food, stuff like that. Now I'm not trying to be a doom and gloom type guy here. I'm just giving you hypothetical situations in which, gold would be something good to hold on to physically. All right, and my own personal opinion is to hold on to some form of physical gold. Okay, and we'll get into the forms of gold here in a second. But if you're gonna hold gold, you wanna basically hold on. There's a 10% rule. You want to hold on to about 10% of your entire investment. On your asset allocation, 10% of it needs to be dedicated to precious metals. So it could be gold, it could be silver, or a combination of the two. Personally, for me, I've got some in paper assets, and then I have some in physical gold. Okay. And I've got about 10% of my entire investment in precious metals. And that's a mixture between paper assets and tangible assets like gold coins and stuff of that nature. Okay? And that brings me to the next piece here, which is the different forms of gold. You got paper gold, you got gold coins like we just talked about, you have gold bars, and then you have something called gold by the gram. Alright? Now, there's 31.03 grams of gold in 1 ounce of gold. And the reason why I wanted to cover that real quick with you is because today I've got here one of my own personal gold bars that I bought. You can see it there. It's a pamp of 1 gram gold bar. Just show you the back there. It's kind of hard to see because of the reflection in the light. But that is a 1 gram gold bar. Okay, bought it through a website, and I'll give you the website link below if you want to look at them. But I went with gold gram bars because, let's just say, okay, for instance, paper gold. If you're going to invest in paper gold, know this, okay? There is not enough gold to back the paper contracts through like COMEX, all right, or BlackRock for that instance. There's not enough gold to back the demand for paper contracts. So with that in mind, just know that when you're getting into gold paper assets, the demand for gold, if it spikes, and I'm talking through like a huge financial crisis of some sort, paper gold contracts, they're not going to be able to basically keep up with the demand of gold. If people try to go in and cash in those paper contracts on gold in a time when the demand is so high, they're probably not going to be able to meet the obligation on those contracts for you. Therefore, you might, and this is just a hypothetical scenario, I don't know for sure if this is what would happen or not, but I've been listening to a lot of experts in gold and silver talk about it, and guys like Mike Maloney and, oh gosh, what's the other guy's name? I can't think of it right offhand. I want to say his name's like Bill Gross or something like that. Anyways, some of these experts that are talking about gold and silver, they're saying that the contracts aren't going to be met if people try to cash out on their gold contracts. So that's just another reason why I want to hold on to physical, tangible gold is for that reason. If that were something to happen, I'm covered. And this, again, is part of being diversified, specifically in precious metals. Okay, so I hold on to paper gold in my portfolio for my retirement, and then I hold on to these gold gram bars that I just showed you. And the reason why I picked the gram bars over like a 1 ounce coin or a 1 ounce gold bar, the reason why I did this is because let's say that there is a freeze up of liquidity, okay, in the economy, and you can no longer use your U.S. dollar to buy goods. And if you can, it's going to cost you a fortune just to go buy a gallon of milk. What do? Well, if you have a gold ounce, 1 ounce coin, like a gold eagle, okay, you might be able to to go into a grocery store or someplace like that and exchange that, all right, for whatever gold's worth at that time. Now, gold, if something like that were to happen, they're saying, guys like Mike Maloney are saying that it could go to $50,000 an ounce. So it would cost $50,000 for 1 ounce of gold. If that were to happen, though, and you had 1 ounce gold eagle on you, and people knew that it cost $50,000 for one of those, do you think you'd be going to the grocery store with 1 ounce of gold and saying, hey, I'd like to buy $50,000 worth of groceries? You're not going to do that. That's unrealistic. A better way to do it would be to carry it by the gram. Okay? Because there's 31 grams that make up 1 ounce of gold. So whatever the price of gold is, you divide it by 31.03. That'll give you the price per gram of gold. And it's a lot lighter. Okay? Most people don't know what the price is on these, so they're not even going to probably think twice about it. It's not going to draw as much attention to you in a time of economic crisis. Not to mention, you're going to be able to keep more of your money. You're going to be able to keep more of your wealth. So why would you want to give away a gold ounce coin that's worth maybe, I don't know, $10,000, $15,000 at the time of an economic crisis, when you can give away a gram, which is going to cost you, it's not going to cost you your wealth, because a gram, depending on the price per ounce, a gram is going to cost way less than what it would in U.S. dollars. It'll cost way less than what it would for 1 ounce of gold in U.S. dollars. Does that make sense? So instead of giving away $50,000 or $15,000 on an ounce of gold eagle to buy groceries or whatever it is that you're getting, instead you just give away a gram, okay? And if you got 31 of those, your gold is going to last you a lot longer, because once you get rid of that ounce of gold, it's gone. And then you have to go to the next ounce of gold. So it's a way for you to draw it out over time and help you survive through a credit, liquidity crisis. Now, I've never lived through one of those, but my grandma and grandpa survived the Great Depression, and I talked to them back when they were still living, and I can tell you, gold and silver is money. So regardless of what the Fed says or the IMF or any of the central banks, a lot of them will tell you it's not money, it's not a form of monetary currency. Well, yeah, not in a free market, not in a free market system like we're living in right now, where all you're doing is printing money out of thin air, and you got fiat currencies backed by nothing. Of course they're going to tell you that, because they don't want you to get off the fiat currency. They don't want you to stop using this currency. Okay? But there's going to come a time, and we're starting to see that with the Brexit. We're starting to see that in the European Union. Pay attention to the European Union, guys. There's 8 countries right now that are lined up right behind the UK, talking about voting referendums to back out of the European Union Western banking system. Okay, so if you don't think that this kind of thing can happen again, think again. All right, and if you're interested in getting some of these gold grams, you can get them by the sheets. Normally they come in like 31 little gram bars, and that covers you for a full ounce of gold. Okay, I'll leave a link in the description below here for one of the websites that I use for that. Other than that, if you got any questions or concerns about gold, you can leave me questions in the comments here, and I'll be sure to try to answer back as quick as possible for you. But other than that, that's all I have today on gold. Remember, guys, income's the outcome, okay? And be patient. And if you don't have any gold on hand, or silver for that matter, I would strongly recommend that you start looking into it. Okay, you don't have to put all your money in it, but put a little bit here and there into gold and silver. So at least you have something. Okay, but that's all I have for today. These are today's investors investing tips, and I'm Casey with howtoplaystock.com, and I'll talk to you guys later.